Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Hello, this is Peter Lewis with an extra episode of my Money Talk podcast. In this 15-minute Money Talk special, I'm going to talk about the heightened volatility we've seen in recent days in mainland Chinese and Hong Kong stocks and their outlook in the light of all the recent policy announcements. China's benchmark CSI 300 index has tumbled almost 10% since mainland markets reopened after the Golden Week holiday. The index was up more than 33% at one stage since the announcement of stimulus at the end of September. And year to date, the CSI 300 has gained almost 12% after returning as much as 24% for the year to date just over a week ago. In Hong Kong, the Hang Seng Index has plunged 4.5% so far this week. The city's benchmark index is down over 12% since October the 7th, having gained as much as almost 33% in the preceding 3 weeks. The Hang Seng is still up 19% for the year, making it among the top performing major indices in 2024. To discuss this further, I'm joined by one of Hong Kong's most experienced fund managers, Alex Wong, director at Alex KY Wong Asset Management.
Peter Lewis's Money Talk.
Alex, thank you for joining me.
Hi, Peter. Yeah.
Let's start by looking at the recent spate of policy and stimulus announcements. What are the positive factors you see from these?
I think the most positive factors is a change in policy stance. I think that the major focus is now to try to reflate asset prices, and we don't hear anymore on those common prosperity, and they also relax the buying restrictions on second home buying, and they probably give up the idea that houses are for living only, not for speculation. So they are allowing the rich to buy more flats. So this is they made a major change in policy stance. So I think that's why we are seeing a change in attitudes from in the government, and I think people actually welcome that. But I think the recent heightened volatility is due to the strong rise, the strong initial rise that was triggered by catch-up buying by foreign funds, short squeeze, and also influx of new commerce in the retail side. So that probably has ended already. So and we are correcting that strong spike. But I think the outlook actually depends on whether we could build a case for long-term value in investing in China. So I think the major change in policies is the attitude towards the accumulation of wealth in China. So I think that probably could be okay in the longer run. But I think people probably still lack the correction because we had been underperforming the world for 30 years. And I think people need some time to regain that kind of confidence.
And are global funds still very underweight in Chinese shares?
I think they are still underweight, but I think they probably have corrected a little bit. And also, there are many foreign funds, I think, are just speculators. So they probably try to ride the uptrend a little bit. And then probably they already cash out because in the last few days we are seeing a huge decline in those giant tech companies, and I think that are the focus for foreign investor. So I think many foreign funds actually are already liquidating their recent positions, and also with the renewed strength in AI stocks in the US and in Taiwan. People actually probably may not need to take risks in China. So I think they are still a little bit underweight because probably they have already exited the recent positions in Chinese stocks. So overall exposure actually may still be low.
And for H shares, are these still trading at a deep discount to their respective A shares?
Yeah, many H shares are actually trading at deep discount. I think that would make Hong Kong outperform the Asia market in the longer run, because many Asia actually may try to do a second listing in Hong Kong. And if we look at the case in media, it is offering at a deep discount to the Asia when it's do its public offering in Hong Kong. So probably the Asia investor know that the prices actually are a little bit inflated due to historical reason. And also for Asia trading mechanism, there are some faults in the trading system because you cannot sell at the day when you buy. And also there are time limits for trading. So if you are very unlucky, then probably you may need to wait for a 30 or 40% decline first before you can sell your stocks. So Hong Kong actually do not have that kind of restriction. So I think many retail investors in China probably may recognize that. I think for institutional investor in China, probably they have some reason that they cannot just sell their A share holding and pump up the X shares. So I think we need the participation of retail investors to correct that difference. So I think in the long run, that's why Hong Kong would be more attractive than the A share market.
And what are the negative factors from this spate of policy announcements and stimulus measures that we've heard so far?
I think the major risk is that if they fail to boost the market confidence, then market would be very disappointed, and probably they would expect this is just another boom and bust. So and every boom and bust actually would take years to recover. So if this time they could not get the market back on track, then probably we would enter into multi-years of doldrum again. So I think that's the major risk. And I think in the meantime, they are trying to do so much on the property market and doing that all kind of things and try to swap the debt to local government debts to central government. So I think people probably welcome that direction, but that is not helping too much on consumer confidence front. I think that is the major problem right now because deflation actually would be the major risk in China. So there are two risks. First of all, if they fail to gain the market back on track, then probably people will lose the confidence because they think even policies could not revive confidence. And then second is if they cannot correct the inflationary pressure at the economic front, and then I think people also would be very worried that because in China actually many sectors are very competitive. So players actually tend to use price as a tool to attract customers. So there's a natural tendency to deflation. So that's why consumer stocks actually fail to hold on to the gains in the market.
And US-China relations, they're still bad, aren't they? And there's nothing in these policy announcements that we've heard that is going to change that.
Yeah, right. That is a long-term negative factors, and that makes China even more difficult to repeat the case of Japan, because in the when Japan was in its lost decades, we have seen the rise of a unicorn in the world. But in China, actually, they probably may not do much in trying to gain market shares in other parts of the world because of the US-China relations. So that would make China a little bit risky. So I think that's why exporters actually are not doing too much in this round of rally as well. So I think that is a long-term risk. But for recent export figures, that is a little bit affected by typhoon. So we need to see the next round data to confirm whether the exports are really getting trouble already.
And do global fund managers still regard China as being maybe just too risky, even after the rise that we've seen? Because you have plenty of other alternatives, don't you? The US market has been hitting record highs. India and Japan have been doing well. Is it just too risky for China to take a risk on China?
Yeah, I think it is a little bit too risky. But the good thing is it is also offer good reward, because the first one up this time actually showed that China actually could give you 30 to 40% upside in a very short period of time. So the reward actually is attractive, but I think they probably know that they should be selective in selecting stocks. Probably consumer names would be out of favor, manufacturing names would be out of favor. So they probably would be focusing on a few sectors only to reduce the risk, because some sectors actually are much more riskier in fundamental.
And so we've had stimulus. We've seen a big rally in the market, a short squeezed out a lot of those hedge funds. We've had some catch-up buying. Where do we go from here? What are the potential scenarios now for the market going forward?
I think there are three scenarios. First is the worst case scenario. People lost confidence again, then we probably would be back to the days that we are edging lower in the long term with very low turnover, and the decline actually would be at a very slow pace. So people probably would not pay too much attention to China market. That's the worst case scenario, that this time we fail to gain back the confidence of the market, and then we continue to edge lower, just like before the experience we have over the last 2-3 years. So second scenario is everything is fine, and then people gain back the confidence. But I think this time, the next round of rise would not be like the first one. That would be at a much slower pace. So we will not be rising 30-40% within 2-3 weeks. I think the next time we would see the case that the China actually are building some long-term investment value case for investor. So they are willing to hold on to those stocks for some time, so that the market, those companies could grow their value. So which is much more or less like the overseas market. So people are willing to sit on to those stocks to wait for them to grow in value. So this could be next blue sky scenario. But I think the most likely case would be we probably may not have too much upside or downside in the index, but I think certain sectors actually will outperform, just like we have seen in probably 2010 to 2020. At that time, certain companies actually had been rising strongly, but the overall market actually are not doing too much. I think that probably would be the most likely scenario, because I think people probably will still avoid some risky sectors like consumer names, like manufacturing names, and or even Chinese banks. So I think many blue chips actually would lack the value case for investor. So they probably focus on certain sectors like the giant techs or some cyclical high yielders or insurance companies. So I think the next rise probably would have less participants from the company side.
So in that scenario then, what should your strategy be in terms of your overall allocation to Hong Kong and China?
I think first of all, because the upside and downside would be huge, so the size of bets actually should be smaller in Hong Kong and China, because this is a risky place to be in, but it offers good potential before. So you have to control your risk with a smaller size of allocation. I think we should not overweight China, Hong Kong, but we could have some smaller allocation here, because the upside potential actually could be quite good, but the risk is quite high. So first of all, the size of allocation should be small. And then I think we should concentrate on certain sectors. First of all, I think giant techs should still be the one to go, because they are the companies which have the most part to grow in value in the long term. Then previously they are not doing too much because of regulations from the government. But I think if the overall policy stance change to asset reflation, then they probably would relax those regulations on those mega tech companies. So they probably would have more room to grow in the businesses. So their outlook actually has improved. So I think they probably would be the one to go. And also because they are big in market cap, so foreign funds actually would be more willing to buy them. So major techs actually should still be one to go. And then I think some cyclical high yielders should be okay as well. I'm talking about mostly resources company like coal stocks or oil stocks in China because the earnings actually are more related to the macro scenario. So if the macro actually improve, then the dividend actually will be higher. And also in the past 2 years, when the overall market was bad, coal stocks and oil stocks are okay. So they are a little bit defensive, and then they have some chance of improving dividends. So I think that they would be safer place to go. And finally, I think insurance company would be interesting because in Hong Kong, China Life and Taiping, they are selling at a very deep discount to its respective A shares. And then they are holding a lot of investment in the Asia market. So they are already giving some positive profit alerts for this quarter. Of course, people would not take it too seriously because they think the Asian market actually already seen the peak in the meantime. So this profit spike actually may not mean too much. But if the Asian market could go back on track, then they probably would be a good leverage play in a bull market. And also in Hong Kong, there's an extra chance that they probably would close the gap between the A share and H shares price difference. So I think they probably would be interesting to own for the long term.
So to summarise then, the sectors you're looking at, internet giants, so companies like Meituan, for example, the cyclical high yielders, which includes coal stocks and oil shares like PetroChina and Sinopec, and also Chinese insurers like China Life. One other stock that's very much in focus at the moment that seems to be geared to a revival in the market is Hong Kong Exchanges and Clearing. What do you think of that?
Yeah, it retreated sharply because I think that people discounting the risk of my worst case scenario. So if we are back to the worst case scenario, then the turnover would be lower again. So people are not that bullish. So they are over bullish in the first one, and then they probably we thinking about this scenario. So they are not that bullish right now. But I think that Hong Kong EX, of course, as a very sound business, and then it would definitely lead the market again if the market turn bullish again. So I think this is a good one to own just in case the market is extremely bullish, and it's of course the price range would be very wild, but the business actually is sound, and also Hong Kong EX actually are delivering many new products like the weekly stock options, and also it has a huge success in its renminbi futures this year. So I think that they are trying to do more things to try to improve the overall fundamentals, not just relying on the stock market turnover. So I think there's a quality change in Hong Kong EX, and of course right now it is still dependent on the expectations of the market turnover. But I think if the market turn bullish again, then it probably would still be the best one the best performer.
And we've created two indices. We had an Alex index. We now have two Alex indices. First of all, your bull index, which is the one that's geared towards that more optimistic scenario. It contains 2 shares of Meituan, 1 share of Hong Kong Exchanges and Clearing, 20 shares of China Life Insurance, and 50 shares of PetroChina. So that very much is in line with your more optimistic scenario and those sectors that you've outlined.
Yeah, right. I think that's because the 2 big shares, PetroChina and China Life, are selling at a deep discount in Hong Kong. So we are hoping that they probably may have some room to catch up with this Asia. And then Meituan and Hong Kong EX actually are the one to own if the market would be bullish again. So the thing is this portfolio actually would not be defensive, so the risk actually is still quite high. So for listeners, I think that they have to be aware of the risk. So probably if you buy these stocks, probably you should not allocate too much of your or too much bets on or too much stakes on them because their upside probably would be huge, but the downside actually also huge. So I think they need to be aware of the risk.
And the original ALEX index, we now call it the ALEX Defensive Index. That contains 1 share of HSBC, 1 share of China Mobile, 5 shares of oil giant CNOOC, and 5 China Resources Power, and also 5 Zijin Mining. Since that was created in September 2023, the index is up almost 24%. The Hang Seng up 11.6% over the same period. So this is the one that's more in line with the cautious scenario that you outlined earlier.
Yeah, I think this one actually would be okay, even if the market was back to the old days, because it has outperformed the market and give positive returns that even the whole market was so bearish. So I think this is quite defensive. Because I think the most important point is China bond yield actually would remain low, even though they are trying to offer a lot of new government debt to the market. But I think the overall liquidity in Chinese people actually is quite huge, so they can absorb that. And also, if the stock market is not too good, then many people will still be conservative and hold on to government debt. So a low yield scenario actually would continue to give support to these 5 shares, and they are also the ones that prove to be value creating in long term, because like Zijin actually and China Resource Power actually they are making new highs in the long term. So they are not like those stocks which are not capable of breaking into new highs. They're actually growing in company size, growing in profits, and also they have better performance in the long term in the share price as well. So I think that's why the people actually like them. They probably would be those structural growth stocks in Hong Kong, which is overlooked by the general public.
Alex, thank you very much for joining me and explaining that.
Oh, thank you.
That's Alex Wong, who is director of Alex KY Wong Asset Management.
You're listening to Peter Lewis's Money Talk.
Money Talk.
And thank you for listening to this special additional Money Talk podcast. Don't forget there's a full episode of Money Talk every Monday to Friday morning, which you can find on peterlewismoneytalk.substack.com and also on Spotify, YouTube Studio and Apple Podcasts. Bye for now.
Money Talk.